Welcome, everyone. I appreciate everyone's time and energy as I am tasked with getting us up to speed a little bit and helping this tax season go along. Um, First, I want to start off by saying that I am encouraging questions. So if you have questions, throw those in the chat box and I'll try to peek in there and answer questions as we go along. If not, I'll save time at the end for our question and answers. Now, if I don't have time to answer your question, my email will be at the end of the presentation. And if you would like to email me and ask a question, I'll be happy to answer it and bill you later. Two other caveats. I am not a professional speaker. And I'm not a professional Zoom speaker. So bear with me as we get through this and we'll try to make this as enjoyable as possible. A lot of information to get through. So let's see if I can get this screen shared here. Okay. Those are my little ones for those that are interested. Let's see.
You know what?
All right. So the 2020 tax update. First, I want to start off by saying, as far as timing goes, the IRS is going to start accepting tax returns right at February 12th is when they're going to start processing them. Now, that is a lot later, maybe two weeks later than they usually start accepting tax returns. However, and I speak for all accountants when I say this, do not wait to get your information in on February 12th. As soon as you receive all your 1099s and W-2s and have all of your complete package of tax information, go ahead and get that to your tax preparer and let them get started, because just because we can't press the button and submit your return until February 12th does not mean that it can't be prepared. Moving forward, I think it's important for us to start with the Tax Cuts and Jobs Act. This was under the Trump administration, and it was really geared towards business owners, and there's some benefits in there for individuals also. But I feel like it's important for us to start here, which was in 2018, and then we can move to the CARES Act, which is in response to the coronavirus. The items that affect the business under the Tax Cuts and Jobs Act was, of course, our rate decreases, but additionally, we had NOLs limited to 80% with no carryback. NOLs is a net operating loss. That is for businesses that generate a loss and they can't take advantage of it in that current year. Previously, they were allowed to carry that loss back to a year that they had income. However, under the Tax Cuts and Jobs Act, since the rates were reduced, they took that away. Additionally, like-kind exchanges were only limited to real property under this act, and that really affects our contractors and other people that has these personal property, that like equipment. A lot of times you can trade a piece of equipment for a piece of equipment and not recognize any gain or loss and just defer it. But that went away, and only real property. So real estate for real estate. Additionally, business, meals, and entertainment, that under this act was now 50% deductible. We have So we have break room snacks are 50% deductible. Anything that's in the course of doing business. No, you can't deduct 50% of your meals for you on spaghetti night for your family. But if it's in the course of doing business, you can deduct 50%. Business interest expense limitation was 30% of adjusted taxable income, in other words, ATI. But under the CARES Act, which we'll talk about in the future, there were a couple of changes that increased that to 50% of adjusted taxable income. The final regulations for partnerships and S corps, there's this huge 11-step computation for allocation between partners. We can go into detail of that, but I'll need another class. Still, does not apply. All of this business interest expense does not apply to small businesses. And a small business, by definition, is average gross receipts of less than 25 million. So for our clients, that is, a majority of people in this area, and for our clients. So under under this act, which is had people all in a frenzy, was the qualified business income deduction, better known as the QBI. This tax deduction allows eligible self-employed or small business owners to deduct up to 20% of their qualified business income on their taxes. Now, this was huge, and as a result of corporate taxes being dropped to 21%, this act did this for all business owners. So all business owners with pass-through activity. For example, if you have a partnership or an S corp and it's reported on your individual tax return, this QBI deduction relates to you. This is just so they can even the playing field. Again, this act was in benefit to business owners. The taxable income thresholds for those are married filing joints, $326,600, married filing separate, single head of household, qualifying widower, trust, and or estate. All of those are half of that at $163,300. The final regulations does provide guidance on the treatment of previously suspended losses, including QBI. Going forward, 2020 going forward, so this would affect us for this upcoming tax season, charitable contributions no longer reduce the QBI deduction, and previously it had. Another act, before we get to the CARES Act, that I like to discuss is the Setting Every Community Up for Retirement Enhancement. That's a mouthful, right? That's why we just call it Secure Act. Yeah, that's why we call it Secure Act. It's kind of the accountant's way of making things extremely difficult when we can really just simplify it. For example, our firm's name, Brockway, Gersbach, Franklin, and Niemeier. Just call us BGFN and everybody can just go on down the road. Under this act, there's business provisions. They increase the credit limitation for small employer pension plan startups. This tax credit is the greater of $500 or the lesser of $250 per 9 highly compensated employees, or 2, $5,000. On the individual side, they repealed the maximum age of 70 and a half for traditional individual retirement accounts, another acronym, IRA, contributions beginning December 31st, 2019. And so, in other words, what this means is you can be over 70 and a half and still contribute to your traditional IRA. In the past, that was not the case. You were limited to having to stop contributing to your retirement account at 7 and a half. Now, to avoid any double dipping, the service also had to make sure that they were clear in the language that those that are taking out qualified charitable distributions from their traditional IRA cannot include this in gross income, and it will reduce the excess of these traditional IRA contributions. So a qualified charitable distribution, this is a tax planning that we use for up to $100,000. If a person is required to take out of the IRA, which is required minimum distribution, RMD, that your financial advisor may have said, what we do is, and they give to their church. Well, since standard deductions is so high, and we're talking $24,000 for married couples, at this point, you get that money regardless. So if you were itemizing and you gave $25,000 to the church, for example, you're only getting the benefit of $1,000. Or if you can take that money directly out of your IRA, not pay tax on it because it's going directly to an organization, that's $25,000 you're saving on taxable income, and you still get the $24,000 benefit of standard deduction. Additionally, they had a penalty-free withdrawals for retirement plans in case of birth of a child, or adoption, not to exceed $5,000, not to exceed 10K if you're married, filing joint. Then it also increases the age of required beginning date for mandatory distributions, what we just discussed, require minimum distributions, to 72 as of after 12/31/2019. The modification required the distribution rules for designated beneficiaries must be fully distributed after 10 years after death. And then there's exceptions to this rule for any eligible designated beneficiary, that's spouse, minors, and disabled person. Okay. The Coronavirus Aid, Relief, and Economic Securities Act, better known as the CARES Act. Here we'll get into this act, and we'll discuss a couple things on the business side first. On the individual side first. Recovery rebates for individuals. Everyone in the room probably now knows that we're just talking about stimulus checks here, and the amounts, there may be more in the future, but the amounts have, if you receive it, you know the amounts. The main thing I want you to focus on here is that, because I get this question a lot, that is not taxable income. You'll see on your tax returns this year, there's going to be a place for how much rebate did you receive, how much stimulus check did you receive, because there are going to be people in situations where they would have received more stimulus checks based off of their 2020 situation versus their 2019 situation. And so let's say you were getting $1,200, you would have had $1,200, but you only got $600 because of limitations. Well, if you were limited any in your 2020 situation changed, there's going to be a difference, and they're going to try to give that money back to taxpayers, issue that money as a taxable refund on your tax return to kind of true it up. But if you received it based off of 2019 in full, they're not going to take it away. The other benefit under this CARES Act is to encourage our charitable giving, because right now with the pandemic, people are holding on to cash. You have the charitable contributions of up to $300 can be deducted as a above the line deduction. Cash contribution could be deducted up above the line. So that means even if you don't itemize, even if you don't have a Schedule A and have mortgage interest and et cetera, but you give to a church, et cetera, you'll be able to deduct $300 from your adjusted gross income, better known as AGI. So it also, for our corporations that are listening, charitable contributions used to be limited to 10%. Under this act, they allow 25% deduction for your donations, for your charitable donations. As a continuation to our retirement, on the retirement side, the CARES Act waived 10% early withdrawal penalty from any of your IRAs, your individual retirement accounts, or any employer-sponsored eligible retirement plan. The CARES Act allows folks that are 59 and a half to take up to $100,000 out of their 401ks or IRAs up until the end of 2020. Now, for those that are worried about a huge tax bill or et cetera, because you had to take that money out, there is a caveat in there that you can include the money over time, over a 3-year spread, or you can elect to report it all in 1 year. And you can also recontribute at any time over the next 3-year period and treat the rollover as non-taxable income. So that means in 2020, if you took $100,000 out and you showed it all as taxable income, but in 2021, you put $50,000 back into the retirement, on your return, you'll be able to get the taxes back that you paid on that $50,000 and going forward. The requirement minimum distribution was waived for 2020. Again, that is those that are required to take out of their traditional IRA. Really quick, a traditional IRA and a Roth IRA are two separate things. The traditional IRA is pre-tax dollars that you're contributing. And so it goes in pre-tax and later on could be tax. A Roth is after tax dollars. And so it is not being taxed when it takes out the gain, or the principal is not going to be taxed when it's being taken out. So that's why they require you to take these minimum distributions so you don't just defer your tax indefinitely. Let me check our chat box here to make sure that we don't have any questions.
Michael, it looks like so far we're good. Folks do want to make sure that it's okay that they get a copy of the presentation for afterwards. I think because there's so much data here to kind of dig through that it'll be helpful to reference afterward.
Yep, absolutely. Absolutely. I will make sure that everyone that's registered for this gets a copy of my full slides. I'll be happy to share it with them.
Awesome. Thanks, Michael.
Yes, ma'am. Okay, required minimum RMDs. All right. So the business side of this CARES Act, as we mentioned earlier, our net operating loss changes. Well, 80% of that taxable income limitation was suspended for 2018 and 2020. So that opens up a lot of people who are under a 21% tax rate now can go back and get that fattened up money, that 34%, with the losses that they incurred in 2020 or 2018 between 2020. The NOLs in 2018 and 2020 can now be carried back or carried forward indefinitely. They must be carried back before carrying forward, however, unless you can elect to waive out of that. There's also an increase in limit on our business interest expense paid, as we talked about earlier. There's a 50% increase there. There's an election to substitute last taxable year beginning 2019 for your adjusted taxable income. And you can amend 2019 if that's something that does affect you. Qualified improvement property. Okay, under the CARES Act, well, under depreciation period, if an asset is under 20 years or less, so 20, 15, 10, 7, 5, if you can depreciate it over that short amount of time, there's a thing called special depreciation where you can bonus it and write the whole thing off 100%. Qualified improvement property was then deemed to be part of your building, which was a 39-year or 27.5-year, which means you couldn't write off any improvements. For example, if I rented our building out and I remodeled the break room and it cost me $15,000, I was originally had to take that $15,000 over a longer period of time. But with this change, it allows you to take it over 15 years, which means you're eligible for 100% bonus. So if you remodel something in a year, you can actually take and deduct that full expense in that year. And the qualified improvement property must be by the taxpayer. So it has to be after the date you put it in service. So you can't buy a building with these improvements already on it and then break it up and deduct it as qualified improvement property. It has to be done after you've obtained a building in a place in service. Otherwise, it's still going to remain at the 39-year. The Paycheck Protection Program, better known as PPP. There's some good news surrounding it. Finally, recently we've gotten news that there's a new simplified one-page forgiveness application for all of the loans that are less than 150,000 or less. And there's no backup documentation. It's simply you're going to have to initial a few representations and that's it. And so that's really helpful to our small businesses that are already struggling during this time. Good news number 2, no matter what form you use to apply for forgiveness, all payroll and other business expenses that you claim will also be deductible. That's huge because before the forgiveness was going to have to be considered as income to offset any forgiveness. But now they're saying you can use the funds that we gave you for expenses and deduct the expenses still. Good news number 3. If you receive the EIDL, Economic Injury Disaster Loan or advance, this does not count against your PPP loan forgiveness. Previously, in previous versions of the rules, that it said the opposite. So another benefit to our loan recipients. Good news number 4, if your PPP loan is forgiven, the amount of that forgiveness will not be added to your income and taxed. Again, for a forgiven loan, the scenario goes like this. You get the loan, you apply for the forgiveness, it's forgiven, and it's not taxed, period. And for our small business people, they will still approve forgiveness of your loan. If you receive the PPP loan, you've got to stay on top of turning in that forgiveness application. If you've already turned in the forgiveness application, these new rules will be retroactively applied to your situation. Most of us have probably already went through PPP round 1. However, this PPP round 2 is relatively new, so I'm going to kind of high level discuss a little bit about it. These loans are available to all businesses with less than 300 employees, whether or not you received the PPP loan previously. Also, to Section 501c6s, but you must meet the following criteria. First-time borrowers, they have a maximum loan up to 10 million. Again, less than 300 employees. The second-time borrower, so if you got in round 1, second time around, your maximum loan amount is 2 million. Again, less than 300 employees. The other kicker to the second-time borrower is you must have experienced a decline in revenue of at least 25% from a quarter in 2020 compared to a quarter in 2019. So if you had $100,000 of income in the second quarter of 2020, we'll turn around, and if you have 75,000 in 2019 or vice versa, then you qualify for this loan. The catch, yeah, it's always a catch. But it's pretty straightforward. You must spend at least 60% on payroll. That's tips, commissions, bonuses, hazard pay. 60% of this loan amount has to be for that. The other 40% must be on rent, company pay, health insurance, mortgage interest, utilities, and things that transportation, computer expenses, so relevant business expenses. Now, if you're a business that is a sole proprietor or independent contractor, you don't have payroll. And so what they call that is owner compensation replacement. That's just 60% essentially of your loan amount has to be used on owner compensation. You must use all the loan proceeds within a time period not to exceed 24 weeks. Before, you had a quick 8 weeks. You had to use all of the money for payroll and other business expenses, 8 weeks. They've extended that to 24 weeks. This is a quick diagram. Again, you guys will get this in a slide, so we won't spend too much time on it, but all it's doing is comparing round 1 and round 2. You'll see here that if you're in a restaurant business, for other businesses, the limit is 2.5 times average monthly payroll for 2019 or 2020, whichever you decide. For restaurants, it's actually 3.5 times average monthly payroll. So that's good. There's a small change to the forgiveness form. In round 2, you're using a 2483 SD. And then you have the limit of the 25% reduction in gross receipts, and then also the less than 300 employees. So, and then it also simplifies your the application for forgiveness, which again is retroactive to round 1. Other tax-related matters, some executive orders. Now, these executive orders actually came under Trump's administration, but Biden is he's enacting to extend a lot of these. So the eviction protection for renters and homeowners. We have deferred employee portion of payroll tax with less than 100K in wages. The IRS recently posted that instructions on their website of how employers should report on Form W-2. So if you find yourself in that situation, you can go on the IRS instructions or consult your tax advisor, and I'm sure they'll be able to help you out. $600 per week on unemployment benefits, which I believe is set to expire this month, at the end of this month. But the way things are going, it will likely get extended in some form. I'm not sure. I also found it important to put in here, given we're sitting at home right now on Zoom or wherever you're at on Zoom, the telework taxation. Now there's employees working from home out of state. And what this does is it opens you up to nexus in those new states. And what nexus means is it just simply means you're doing business in that state, especially if an employer already has some other activity in that state, such as sales. This nexus, it may open up employees to individual income tax concerns or withholding. Proposed legislations right now is to exempt workers if they work out of state for 90 days or less. This bill dictates tax and jurisdiction is that an employee with no nexus is created. Keep good records. As like we always say, keep good records and you'll be fine. The home office deduction, unfortunately, is not available to us as employees. I know my bills increased also. I had kids working from home. I was working from home, but there's no deduction for us. However, self-employed people and independent contractors, they still get that home office deduction. Student loans. Student loan payment and the 0% interest. I know, remember when Trump extended it to the end of the year, it is now extended to, at least for right now, September 30th, as they figure out whatever they're figuring out in Congress. But for right now, September 30th, you don't have to pay any student loans. This act recently also extended the employer assistance for student loans all the way to December of 2025. Now, the reason that's important is because I find it a great tax planning opportunity. Your employer can pay up to $5,250 worth of student loan payments, reimburse it directly to you or paid on your behalf to an employee on a tax-free basis. The reason I say this is a great tax planning opportunity is because you can work out with your employer your salary. Let's just say I'm already paying student loans and I already pay I think it's like $440 what that comes up to. I already pay $440 a month. Well, I'm paying that with after-tax dollars. In this situation, if you can just reorganize your payment, how you're paid, you can actually take home more money. It actually increases you because you're not paying federal taxes on this money or Social Security or Medicare. And so you're essentially like you're paying your student loans with tax-free dollars. And if you take advantage of it now, all of this money is going to principal, given that there's no 0% interest and no required payments. So again, consult your tax advisor on that, and maybe something that your employer may not even be aware of. So that'd be something that would be good for you to bring to their attention. Further Consolidated Appropriations Act 2020. Okay, under the business side, there's a work opportunity credit. This was extended for 1 year for 2019 and 2020. This is available for those that are providing work and have employees. So that is extended. Individual provisions, there's an exclusion from gross income of up to $2 million for qualified residential indebtedness. So that means if a bank forgives your debt, you can exclude from your income up to $2 million, but it has to be your principal residence. This kind of came into play when when homes value were going down and being foreclosed on. And so this protects those people. The treatment of mortgage insurance premiums. Before they were non-deductible. This was extended to 2020, allowing people that do itemize and take mortgage insurance premiums, they have to pay mortgage insurance premium, they're allowed to deduct that as interest expense, as additional interest expense. There's a reduction of medical expense. The floor went from 10% to 7.5% through 2020. There's been a deduction of you can deduct qualified tuition and other related expenses. That also was extended to 2020. Some other tax items. Really quick for our business owners and charity givers and people driving, using their vehicle for these items. The standard mileage rate for 2020 are 57.5 cents per mile. Charity is 14 cents. Medical and moving is 17 cents. Now, moving is non-deductible for us civilians. However, there is a caveat there. If you're military and you have to move, you still may be able to deduct moving expenses. Depreciation limits for 2020 are seen there. Bonus is still at 100%. Again, this is a huge benefit because you can buy a $60,000 piece of equipment and take bonus on it and deduct it all in 1 year. Now, the reason I put this in here, and the reason we like to talk about it is because it's the future, and we're now in a new administration and things always change. So we have to prepare for the worst. We have to prepare as if these things are going to get passed. I don't know if it's going to be, this is just Biden's idea of his perfect tax system. And so we don't know if it's going to be passed or not, but high level, here it is. 12.4% of your Social Security tax on income. So there's going to be like a surtax on income over 400K, evenly split between employer and employee. There's no tax for wages between 137,000 and 400K. He's going to revert the individual tax rate from 37% back to 39.6% for taxable income over 400K. Taxes long-term capital gains and qualified dividends at ordinary income tax rate. So of all of this, I think that's going to be the hugest one. When you talk about having over $1 million income and the people that are doing capital gain transactions who invest in, et cetera, they will be taxed at ordinary income rates at the highest rate. So it caps tax benefit of itemized deductions to 28% for those earning more than 400K. So they won't get the full 39.6, but if they're in the highest tax bracket, they won't get the full benefit of their itemized deduction. It'll limit it. It phases out the QBI for income, taxable income over 400K. This is also huge. We have, even this affects us. We have people that make more than this and was getting the benefit of the QBI that we tax planned around it, and it may go away. He expands the earned income credit for childless workers, age 65 plus. He expands the child and dependent care tax credit from $3,000 to $8,000, $6,000 for those with multiple dependents, and increases maximum reimbursement rate from 35 to 50% for your child care expenses. Other individual proposals, remember, these are just proposals, so don't say Mike told you all these things. I just want to make sure we're on the same page. In 2021, as long as economic conditions require, he increases the child tax credit from $2,000 to $3,000 for children under 17 and under, while providing a $600 bonus credit for children under 6. He reestablishes the first-time home buyers tax credit to encourage home buying. He also expands the estate and gift tax by restoring rates and exemption to 2009 levels. Just to give you an idea of what that would mean, at 3.5 and 1 million for those two respectively, right now, the estate, you can die today and have like $11 million estate and it not be taxable. So to revert all the way back to 3.5, that is going to be a lot of people we have to tax estate plan for, a lot more. Some business proposals. We mentioned earlier that the corporate tax rate is 21%. He wants to move that back up, not all the way back to the highest rate, but he wants to move corporate tax rates to 28%. Minimum tax on corporations with book profits of 100 million or higher. There's a caveat here that if you can have a great year on book purposes, but on tax purposes, there's a difference because there's a lot of depreciation and et cetera. So he's saying for those extra large corporations that you're going to have a minimum tax on if you're over 100 million in book profits. Double tax rate on global intangible low income earned by foreign subsidiaries of U.S. firms. That's a lot, and essentially trying to keep taxes paid here in the U.S. Establish a manufacturing community tax credit to reduce the tax liability of businesses that experience workforce layoffs or major government institution closure. Last but not least, he expands the new market tax credits and make it permanent. He offers tax credit to small businesses for adopting workplace retirement savings plans and expands several renewable energy related tax credits and in tax subsidiaries on fossil fuels. I know that was a lot. I know that was a mouthful, but I am going to open up the floor for questions. And again, I'm going to leave my email here for those that want to email me something specific or have further questions. Mary will email everyone that's registered a copy of the slides. Thank you so much for coming to my TED Talk.
Michael, thank you so much, because I feel like you're kind of wearing a superhero cape and saving the day for us today, just because this is a lot of education and can be difficult to get through without an expert like yourself. And we do have a couple of questions popping up in the chat. The first one is from Tammy, and it echoes a question I had for you as well, which is going back to the student loan payment. And doing that in a manner so that it's coming for the borrower from non-taxable income. And can you tell us a little bit about how an employer would set that up, what the employee would need to do to set that up to make sure that it all runs properly?
Right. So essentially what it would be is them doing an education plan. I'm going to go back to that slide if that's okay, so you guys can Perfect. Look at it. Okay, so what they'll do is they'll have an employee assistance plan, and it'll be in their employee manual. And what it says is we'll pay up to $5,250. And you can agree, it doesn't have to be this full amount. Let's say your student loan is only $150 a month. But you can do that. But what I would do is I would have the employer reduce my salary by the $5,250. Okay. And what this does is it's a 1-for-1 for them. Okay. And so there's no change. It's a net zero for them. $5,200, actually a benefit for them because they're not paying the employer taxes on that amount. Okay. And so it's a decrease in deductions for them, and it's an increase in net cash income. I'm gonna do a little math here, okay? So let's say you use the entire $5,050 and you're in the 22% tax bracket. And you're saving the 7.5 of Social Security and Medicare taxes. So that is 29.45% in savings on that $5,250, which that equates to about $1,500. Okay, that's $1,500 a year you're saving, and if you divide that by 12, you're looking at taking home an additional $129 a paycheck, or a month. I'm sorry, a month, and your student loans are getting taken care of. But it should be simple as them saying, "We'll do this. We'll reimburse you, or pay it." So they can do it any way they want, and it's pretty easy to deduct. It's not something that it's an internal deal, so it's not something that they have to report on or etc. They just create a line on their profit and loss that says Education Assistance Program, and they'll take it as a deduction, and it's a non-taxable benefit to us.
And then if I'm understanding this right, the borrower would then make their payment from their personal banking account as they typically would, right? Because their salary has been decreased. Is that right?
Yeah, so, well, no, in that case, the employer would make the payment directly to, so there's no,
Got it.
you see, so you've actually take home $129 more because that's just the tax savings.
Got
but and you're getting rid of a bill, or you can leave everything the same and encourage, let's say you're getting ready to get a raise, and say, hey, I don't want the raise, instead I would like to be reimbursed for my education expenses, and then it's an offset, and they can do it that way also.
Got it. So there are options to make it work.
Yes, ma'am.
Perfect. And Kirsten has a question as well on the small business side about going into entertainment and meals and the percentage of taxation on those.
Mm-hmm. Okay, so that is going to be 50% for your meal. So if I spend $100 on a client dinner, better example, I have employees sent out on the job site, and they're required to have a meal provided by us, a business meal provided by us. Well, I get to deduct $50 of that. Now on your books, it's $100 expense, right? So you have the $100 deduction on the book side of it. So it's $100 loss of cash flow. However, on the tax side, you cut that in half, and you can only take as a tax expense $50 of it. Okay, and the other $50 is a disallowed expense.
Got it. And I think that covers it, Kirsten. Does that answer your question?
Yes, thank you.
Okay, perfect. Mike, I've got a question for you. Just as we sort of get into tax season, which I'm sure is the busiest time of the year for you, what advice would you give to individuals and business owners as we prepare to meet with our accountants, as we start to get ready? Any kind of like tips from the expert in terms of what we can do to make your life easier?
Yes. So, first things first, it's tax season for us because you have a short period of time to do a lot of information, right? It's the consolidated time for a lot of people. It's all about efficiency. So if you can be and help us be efficient, it actually saves us time and saves you money. Okay. The quicker we can gather information and put stuff together and formulate a calculation for your taxes, the cheaper it is for our clients. And so I would recommend that if you receive a W-2, but you're getting 2 more W-2s, wait until you get all of your W-2s and then go sit down with your tax preparer, or then go drop that stuff off to your tax preparer. Try to be as complete as possible with your information on the forefront to save the back and forth. And that's where all the time comes in. Save the back and forth between you and your tax preparer. The other thing I would advise people to do is, if you have a tax preparer, for us, we send out tax organizers. This allows our clients to know exactly what they should be looking for and the information that we need ahead of time. And so if fill that out as best you possibly can. If you have any questions, you can call. But if that information is filled out, a lot of the information we need, and you won't miss getting it to us, is provided in that organizer.
Perfect. So efficiency is the name of the game in tax season. And just to take it back to, I think it was your first or second slide, so I apologize because it's going all the way back, but you said that the IRS is going to start processing those returns on February 12th this year, correct?
Yes, February 12th is when they'll actually be able to. So, you know, even if you're at home and you say, I'm going to do TurboTax, you won't be able to submit your return until February 12th. They won't start accepting and processing those returns until February 12th.
But whether we're doing it at home online that way or putting everything together in the tax organizer, it sounds like we can have everything lined up and ready to go so that February 12th, we're essentially first in line to get that information over. That
is correct. And as soon as, like, you know, for example, I prepare a return. I have people that have gotten everything that they would have. They're stacked up on February, you know, a week before. I'll go over their return with them. They'll give it their blessing and say, okay, yes. And they'll give us an electronic submission form. And then we'll be able to press the button and send it off to the service for processing.
Perfect. And Michael, I'm going to just throw your information into the chat, your email address. I know it was on the last slide. But do we have any more questions from the audience before we wrap up today's conversation?
Hey, Mike, while we're waiting for other questions, I just want to thank you so much. This was so informative. And for me personally, the school loan information was great. I never realized that you could do that. So thank you, because I think you just saved me $129 a month.
Yeah.
So we really appreciate it. And I would encourage anyone to reach out to Mike with questions. And as Mary had stated before, we will send this presentation out to everyone. So again, thank you all. Happy New Year, everyone, and stay safe.
Yeah, thanks for tuning in, everybody, and keep an eye out on the THPD YouTube channel because we'll have Michael's recording up later today. And Michael, thank you again so much. I'm pretty sure we're probably going to be flooding your inbox later on.
Thank you so much. Thank you so much. Thank you guys for having me.